Hello and welcome to the 800th meeting, actually, of the Economic Club of New York. 800 meetings, a lot of meetings over 118 years. I'm Barbara Van Allen, President and CEO of the club, and it's a pleasure to be here with all of you. Before we begin, I want to extend a warm welcome to students joining us virtually today from NYU and the Gabelli School of Business at Fordham, as well as members of our 2025 class of fellows. The Economic Club of New York is proud to stand as the nation's leading nonpartisan platform for discussions on economic, social, and political issues. And we've been doing this for more of a century. Today, we're honored to carry on that tradition and welcome back our distinguished guest, Mark Zandi. Mark's the chief economist at Moody's Analytics, where he leads their economic research efforts. Moody Analytics, a subsidiary of Moody's Corporation, is a top provider of economic data, research, and analytical tools. He's also a co-founder of Economy.com, which was acquired by Moody's back in 2005. Mark serves on the board of directors of MGIC, the largest private mortgage insurance company in the United States, and he's the lead director of PolicyMap, a data visualization and analytics platform widely used by policymakers and businesses alike. He's a trusted advisor to leaders in government and business, frequently called upon to provide insight and testify before Congress. He's also regularly briefing corporate boards, trade associations, and policymakers at all levels on the state of the economy. He's the author of Paying the Price, Ending the Great Recession, and Beginning a New American Century, a comprehensive look at the policy responses to the Great Recession. His other book, Financial Shock, a 360 look at the subprime mortgage implosion and how to avoid the next financial crisis, was called The Clearest Guide to the Financial Crisis by the New York Times. He also hosts the popular Inside Economics podcast. He earned his bachelor's degree from the Wharton School at the University of Pennsylvania. Today's program will be a fireside chat, and we're honored to have fellow club member Peter Coy, freelance economics journalist and former contributor to the New York Times and Bloomberg Businessweek. In addition, we'll be using the chat box for this conversation. You can enter questions directly in the chat box for their consideration, time permitting. As a reminder, this discussion is on the record. We do have media on the line, actually quite a bit, and we're going to end promptly at 1 p.m. So now, without further ado, happy to pass this time over to you both.
Thanks, Barbara. Mark, looking forward to this conversation. I'm also happy that we're doing number 800 here. We got a landmark event. And Mark, we've known each other since you were at Economy.com, and you've always been a straight shooter, so I'm sure you will be again today. I guess I'll start by just letting you give tour of the horizon view of where you think the U.S. economy stands right now. And you don't have to go into great depth on anything because we'll doing some follow-ups. Just want to get the big picture.
Yeah, sure. Well, thank you, Barbara, and thank you to the club for the opportunity. I always appreciate the opportunity. And Peter, thank you for doing this. I think we've been chatting for at least 30 years, maybe 35 years. I became a professional economist in 1990, and I think soon thereafter we were talking quite a bit. So it's really good to have you as the moderator here. I really appreciate that. And I promise to be brief, because there's a lot to talk about and think about. But I think the economy, and here I'm going to mostly focus on the U.S. economy, although we can think globally as well. But I'll focus mostly on the U.S. Is struggling under the weight of economic policy, and most specifically the global trade war. And I think if the trade war doesn't de-escalate soon, and when I say soon, I mean weeks, not months, I think the odds are high, better than even, that the U.S. economy and much of the global economy is going to suffer an economic downturn. I think the blow from the trade war to confidence and is serious. You can see it in all the confidence, the sentiment measures, businesses, consumers, investors. I think the tax hike, the effective tax hike that's coming as the tariffs are affect import prices and consumer prices more broadly will be very significant. I think the wealth effects from the lower stock market are going to be quite powerful and probably more potent than in times past. And I think the longer term consequences of this could be serious. I think there is a growing nervousness among investors about the safe haven status of the United States. It goes to the nature of this crisis and some of the things that are being that are coming out of Washington, a lot of governance issues, and that could have significant long-term economic implications as well. So, bottom line, Peter, I think the economy is on the precipice of going into recession and will likely go into one unless policy takes a very sharp turn here pretty quickly.
Yeah. I think on CNBC a couple days ago, you said about maybe a 60% chance of recession. Do you feel comfortable with that?
I do. Just for context, coming into the year, I thought the probability of recession was pretty close to its unconditional probability of about 15%. So we have a recession every 6-7 years. You do the arithmetic, about 15% probability in any given year. Felt like that's where we were. We came into the year, the economy was operating very well, strong growth, lots of jobs, unemployment was low. Inflation was a bit elevated, but was nicely coming in. In fact, as we've seen in subsequent months, it was, headed right back to the Federal Reserve's target. The stock market was at a record high, housing values at record highs. It felt, of course we had our issues, but we always do, and it felt like we were in a pretty good spot. But here, 4 months in, 3.5 months into the year, I think 60% probability is a pretty good way of thinking about it. I will say, and this is just maybe a nuance only nerds would appreciate. And of course, if you're listening to this discussion, you're probably a nerd, so you're probably all in on this. But at Moody's, we do these very explicit forecasts for the U.S. economy, for the global economy, for regions, for industries. We have models. We produce these forecast scenarios, put them in databases. In our April forecast, still does not feature a recession in the U.S. It does in Canada and some other places of the world, but not in the U.S. And that may sound incongruous to the statement that I think the probability is 60% that we're going in. And that's because if I incorporate a recession into our forecast, I have to be very confident in that. And when I say confident, the kind of the subjective threshold I use is a 2/3 probability or more that we're going into recessions. Once that happens, then we'll adopt that as part of the baseline. But the baseline right now is a weak economy, a struggling economy, rising unemployment, but not one that actually goes into recession. But we're splitting hairs here. It's pretty close.
I'm going to push on that just a bit. Why would you insist on a 2/3 probability before calling a recession? Is there something unique about a recession call that justifies that higher threshold of reliability?
Well, actually, good question. It's not just a recession call. If I make any major change to any underlying economic assumptions, I have to be equally as confident. So the threshold is high for making a major change. So if there's a assumption around Federal Reserve policy, if there's an assumption around fiscal policy, is there assumption about something that's going on overseas, some geopolitical event in the fallout of that, for me to make a change in that underlying assumption, I have to have a high degree of confidence. And that 2/3 threshold is what I've developed as kind of my benchmark over the years. Once I'm there, I feel very confident. Once I feel very confident, then I'll make that change. So it's not just a recession call. It's broader than that. Yeah.
And now you've talked about growth. What about inflation? What's your inflation outlook this year?
It's going up. This goes to the tariffs in the trade war. And just to give you context, if you look at all of the tariffs that have been announced and are headed, or either have been implemented or headed towards implementation, everything from the 10% base tariff to the reciprocal tariffs that will be imposed, under the current discussion in 3 months, to autos, to USMCA, so forth and so on, the effective tariff rate. So just take all the tariff revenue that will be generated by those tariffs, divide by the value of imports that are being tariffed, and account for the fact that you're going to consume less of something that's being tariffed, and there's going to be some trade diversion from high tariff countries to low tariff countries, the effective tariff rate is going to go to somewhere around 22, 23%. But prior to all of this happening at the start of President Trump's term, we were at a 2.25%, 2.5% effective rate. So let's make the arithmetic simple. Say the effective tariff rate is now going to rise 20 percentage points. A good rule of thumb is that for every percentage point increase in the effective tariff rate, that will add 10 basis points, 0.1%, to the inflation rate as measured by the consumer expenditure deflator, the so-called PCE deflator. That's the inflation measure the Federal Reserve uses for setting its target, setting monetary policy, and its target is 2%. So do the arithmetic. 20 times 10 basis points is 2%. So if the inflation rate today, and I'm making this up, but roughly speaking, is 2.5% on the PCE deflator, a year from now, if everything stays where it is today, the inflation rate will be 4.5%. So we're going from 2.5 to 4.5. Now, I don't have that kind of increase in inflation because, you know, that doesn't fully account for the weakening in economic growth and demand and all the other kinds of things that go into making an inflation forecast. But the bottom line is, if these tariffs go in anywhere close to what they're currently being advertised, inflation is going up, not down, and going up in a meaningful way.
Question about how you calculate the PCE deflator impact of tariff changes. Do you figure in that companies, retailers and importers will imply a percentage markup to the landed costs? The other way that they could do it is to have sort of a dollar markup. But and that's kind of an exception to the rules. Seems like normally they just, but I just wonder what your calculation method is and how that affects your numbers.
Yeah, it's really based on that rule of thumb is based on simulations of a large scale econometric model that has embedded in it these elasticities with regard to tariffs. Tariffs go up, they have an impact on import prices, which then have an impact on the prices that we pay, the consumer prices that we pay. And that it's really more of a percentage. It's kind of a markup, the way the model is structured, but it's more on a percentage basis than on a dollar basis. The model has a little more richness than how I just articulated in that we do this for a range of different imported products. So it's not just overall imported goods, it's different types of imported goods. Some have the elasticities, the markups are higher or lower, and so you have to account for all those things. Some are more impacted by the dynamics that result from the tariff increases on economic growth and on demand and how that reverberates back. So it's kind of more of a dynamic kind of estimate of the, you know, the elasticity between the tariff increase and what it means for overall prices. But that's the methodology we use. It's not inconsistent, though, if you go back and take a look at kind of micro analysis and go back and look at, you know, kinds of the impacts on prices of tariffs under President Trump's first term in that trade war. You know, there's a large range of estimates based on different techniques and different how different researchers did their work. But broadly speaking, the results we're getting are we're using this macro approach is very, very similar to the kind of results you would get if you did that kind of micro kind of analysis that researchers do.
So, by the way, I want to urge everybody on the call who has a question to put it into the chat box. We don't need to wait till the very end to take your questions. You can jump in at any time. I'll be keeping an eye on the chat box. I'm going to ask you, Mark, a very obvious question now, which is that you've sketched out a scenario where growth weakens, which would otherwise call for the Fed to cut interest rates, but also inflation rises, which all else equal would cause the Fed to hold steady or raise rates. What is the upshot of those two counteracting forces?
Well, the upshot is, at least for a while, when I say a while, at least a few months, is the Federal Reserve will sit on its hands because meaning no change in policy, because it doesn't know how to respond for the reasons you just articulated. What do I do? do I respond to the higher inflation expectations, or do I respond to the weakening in growth? The answer is I just don't know. And adding to that is just the uncertainty of the policy itself. I mean, these tariffs are being changed daily, hourly. They'll change again. And there's other economic policy that plays into this as well that's also as equally uncertain around fiscal policy, tax spending policy, Treasury debt limit, immigration policy that can matter quite a bit. What's going on with government DOGE cuts for jobs and government funding. So there's a whole slew of economic policy that's in flux. So given that uncertainty, until I have and it's never going to be certain, but until I get a little bit of clarity, a little bit more clarity around that, I think the Federal Reserve just sits on its hands. So I don't expect the Fed to move here, for a few months. I do think ultimately that the growth effects will outweigh the inflationary effects. That there is some reason to be nervous, and Fed Chair called this out yesterday in his talk and his speech in Chicago that look, inflation expectations are elevated, actually more than elevated for consumers, and there is a threat that the increase in prices and inflation caused by the tariffs gets more embedded entrenched through those inflation expectations affecting wage demands and businesses raising prices, and you get into the kind of a wage price spiral. So there's a lot of concern about that, but I think very quickly we're going to find that the inflation, while it's still well above target, is not going to be the problem. The problem is going to be growth, and the Fed will ultimately start cutting interest rates later this year. So in that baseline forecast, that no recession forecast I talked about earlier, we have 3 quarter-point rate cuts, one in July, one in September and December. If we actually go into recession, the rate cutting, I think, will be larger than that. There'll be more aggressive in cutting rates. But barring that, I think that's kind of the path forward. But let me just say, Peter, as you can sense, I forecast many things. Some things I'm confident in, some things not so much. That might be the not so much, because we'll have to see how this plays out, and which direction this goes. I will say one final thing though is I do think a necessary condition for the cuts is the confidence by the Federal Reserve that inflation and inflation expectations are contained. Not that they're back to target, but that they're contained. They're not going to continue to accelerate, and they are going to start to come in, or are already starting to come in before they actually, start to cut interest rates. So I think that's a necessary condition for the rate cuts.
It's a necessary condition, but that's actually a tough condition to attain, because if indeed we're having high inflation, and we do see inflation expectations having risen quite a bit lately, it would seem like the Fed is going to be quite torn. And it seems like you're coming down to the idea that if there is this contest and it's not resolved, would they be willing to hold off on cuts, which would increase the risk of recession, just to make sure inflation doesn't get out of control?
Yes, I very much, I believe that's a necessary condition. They have to feel highly confident that the inflation and the inflation expectations are not getting entrenched, that this is not going to become a more persistent problem, that it in fact is a more of a one-time pop to prices, and that's the end of the story. So, thus my lack of confidence here, because will they have that confidence by July? That to some degree depends on the tariffs themselves and how quickly they're imposed and how that quickly they get passed through. So, July may be too early. So I wouldn't argue that. I will make one other quick point. There is this, the rest of the world is, easing monetary policy, right? Because they don't have the same kind of inflationary concerns, as we do here, because tariffs aren't going up nearly as much in a broad-based way. So we are starting to see rates come in overseas and also in China. So one of the ways the Chinese are responding to the weakening in their economy because of the tariffs that we've imposed on them is to lower interest rates, and that will help to ease, some of the downward pressure on their economy. While, over here we're still stuck at higher rates because we're going to be concerned about those inflationary pressures. So that affects kind of the balance of the leverage between these two countries in this, debate over the tariffs and who should blink first. I think there's a general view that, from the administration that the U.S. has a upper hand here because of our trade deficit with China. I'm not so sure, and one of the reasons why is just this: the Chinese have more latitude to use monetary and fiscal policy to support their economy than we do.
Yeah. And we started getting a lot of great questions coming in from the audience, so I'm not going to be able to handle all of them, but I'm going to pick some out. There's a good one here. Any thoughts on the gap in inflation expectations between the Michigan survey and the swap rate, the inflation expectations that are implied by the swap rates, which are relatively stable?
Yeah, relatively stable. I mean, I think there is this, I think American consumers, thus to the University of Michigan survey, are very, very nervous about what tariffs mean for the prices they pay for the food and groceries, other things that they're buying. Very, very, because of what we've been through, the high period of high inflation, I think consumers are just very much on edge here. And so any whiff that prices are going up for any reason, including tariffs, that quickly spooks those folks, and you can see that in the survey responses. I think the kind of the financial market expectations, they're kind of the same mind I am, that the Fed's not going to allow that high inflation to get embedded. That at the end of the day, the Fed's going to be very aggressive in raising rates if they need to keep inflation intact. So it's still faith that the Federal Reserve is going to do the right thing with regard to inflation. That so their expectations are more anchored than I think consumers. I will say though, typically when you see this is a bit of another nerdy point, when you see oil prices down, you see bond market inflation expectations down, and oil prices are down. The WTI is West Texas Intermediate, it's like $60 last I looked. Brent 65. That's down 10, $15 a barrel from where it was. But despite that, inflation expectations in the bond market have not come in. So there may, controlling for all these things, I think bond investors are also getting a little bit nervous. The other thing I'd point out is if you go look at my favorite measure, bond financial market measure of inflation expectations near term, is you can look at like 1 year ahead tips break evens, and they are signaling some concern. You can see that they have risen. So I think consumers are more on edge, obviously, given what they've been through. Yeah. But I even think that bond investors and other financial market participants are also more nervous than you would think, looking at kind of the 5-year forwards or 5-year tips or whatever people are looking at.
Yeah, one other point, just sticking on inflation, is the people who are not so worried about inflation will say that an increase in prices caused by tariff increases is a one-time step change in the price level and not necessarily an ongoing cause of rising prices. How do you feel about that?
I think that was generally true in President Trump's first term, because back in that period, in the wake of the financial crisis, inflation expectations were dead as a doornail. Inflation was going into that period below the Federal Reserve's target. People had not experienced any period of high inflation for, you had to go back into the 80s for that kind of experience. So very different kind of environment. So in that trade war, that first trade war, that was a one-time event. You saw it pass, you saw some pass through. It was on a much smaller scale, so you didn't really even see it in the broader inflation statistics. It wasn't that big. It wasn't a big deal. This go around, I feel like inflation expectations are going to be tethered enough that this is going to be more one-off than something more persistent. But I don't say that with a lot of confidence, just like what Chair Powell was saying yesterday in Chicago. He doesn't either. And I think with good reason, because we've been through a period of high inflation. So people are more attuned to the inflation. Inflation's above the Fed's target. And inflation expectations, particularly among consumers, isn't anchored. It feels like it is kind of off the moorings. And therefore, I would be more worried that this is more than just a one-off kind of pop to prices, that it could become more entrenched in inflation expectations, then translate into stronger wage demands. And because businesses feel like they can pass through, they'll allow those wage demands, pass it through, and you're into that kind of self-reinforcing negative cycle. So that the risk of that happening is much, much greater today than it was back in 2018, 2019 during the first trade war. So it's something that can't be dismissed.
Right. Question about the dollar. We had a one or two questions coming in from the audience about the dollar, why it's weakened. Econ 101 says that when you improve your, not improve, but if you have more of a trade surplus, then your currency tends to appreciate. That's not happening here. What do you think's behind that?
I'm nervous that it's global investors are becoming nervous about the safe haven status of the U.S. That and I should say this is what's happening with the dollar and long-term interest rates is very counter to what happens typically in a crisis. In a crisis of this scale, a global crisis, and I consider this to be a crisis, money flows into the United States. We're the safe haven currency, we're the reserve currency. We're money good. We're AAA. We're the best, safest place on the planet. That's not happened in this go around. As you mentioned, the dollar is down against most currencies, and the 10-year Treasury yield it hasn't risen a whole lot, but it hasn't come in. You would have expected it to be south of 4%. It's definitively north of 4%. Last I looked, we were at 4.3%. So I do think there's a growing sense of unease among global investors that perhaps the U.S. isn't the safest place on the planet, or certainly not to the degree that it was in times past. I think there's good reasons to be nervous about that, and I think it goes to this policy, the trade war. I think it goes to just some of the things, some of the kind of conversation coming out of the White House and some of the writings of leadership in the White House, from the chair of the Council of Economic Advisors, even questioning whether the reserve status of the U.S. is something that, is desirable. It's more of a burden as opposed to an asset. And, even last night, Chair Powell gave a talk in Chicago and made it pretty clear, about as clear as any Fed chair can make it, that he's not going to cut interest rates until we get some clarity around all of this and what it means for inflation expectations. And of course, President Trump posted last night pretty strong words against Chair Powell. And I think most investors look at that and say, well, isn't that an attack on the Fed's independence? And I think most investors feel, rightly so, that Fed independence, central bank independence is a cornerstone of a well-functioning market economy, that if setting interest rates is politicized, then ultimately that's going to end in a bad place for the economy and for them as investors, but particularly because it often leads to inflation. When central banks are captured, the executive branch tends to want lower interest rates to kind of get through things, even though that will result in higher inflation. So I think all of that is starting to seep into the kind of general consciousness of investors and global investors, and it is being reflected in higher interest rates. And Peter, this is a problem in the near term, but it's more of a problem even longer run, because even if all that's happening here is the 10-year yield is going to be 1, 2, 3, 4 basis points higher as a result of this growing angst around the safe haven status. You multiply that by $30 trillion in debt, that's a lot of interest payments, for generations to come. And to give up, that reserve currency status, that safe haven status, in my mind, is a very serious error, and it's going to result in, very significant problems in the long run. But I think all of that is now contributing to, what we're observing in financial markets today, the weaker dollar and, the somewhat higher interest rates that on the 10-year Treasury.
Do you think that Powell will be able to hang on till the end of his term as chair? And B, when his term ends, what kind of a person do you think would replace him as chair?
Goodness, I hope so. I think that would be devastating if he's not able to remain in place until his term is over. I think that would be highly counterproductive and lead to more turmoil in financial markets and ultimately a much weaker economy. So I'm very hopeful. And I do think whomever the president appoints to be the next Fed chair will be very telling. I think it's critical. It's I'm not going to speculate on who that's going to be, but I think that's going to be a real tell with regard to how he's thinking about the Fed, the conduct of the Fed, the independence of the Federal Reserve. All of that will, I think, we'll get much more clarity around that depending on the person that he decides to appoint to that position. That is going to be a very critical kind of inflection point. I think we'll get a clearer understanding of kind of how he's thinking about all this and what it means for us, what it means for our economy.
Yeah. Now, Mark, I remember when you started economy.com, a lot of it was about making regional forecasts, right? That was a really cool thing you did. And so you were very concerned about manufacturing, and I think you still are. Of course, Trump's stated ambition for all this stuff is to reindustrialize America. Do you think that he's on the right track? Or if yes, then why? If not, why not?
Your good memory. Yeah, when I founded the company in 1990 with my brother and a good friend, we were regional financial associates. And it was all regional because that was the interstate banking, and the banks were trying to figure out the world in a different geographical footprint. And it was also the PC was coming on board. So we bought these IBM PCs and compacts, and we were off and running. And then we became economy.com in during the bubble. I paid too much for that URL, I'll have to tell you. Way too much for that URL. Still have it, but way too much. I'm sorry, what the question about manufacturing. Yes, yeah. You got me reminiscing here, so I forgot where I was going. Look, I think a trade war and tariffs are not going to bring back manufacturing into the United States. I do not think that will be the case. The kind of the intuition is pretty straightforward. Pretend you're the CEO of a global, and I'm sorry about the dogs. I'm sure you can hear them, but I'm here alone at home. You're that CEO. You're trying to make a decision as to whether you should build that new car factory in the United States. And that car factory, under the best of conditions, won't be ready to produce cars for another 3, 4, 5 years, something like that. And you're sitting there and you're saying, okay, well, a big part of my decision is going to be around what the tariffs are going to be. They're high today, but what are they going to be next 3 years from now, let alone next week? And what are they going to be 10, 20 years from now? Because these are long-lived investments. You're going to be producing cars for a long time. And the answer is, I have no idea. How can you possibly answer that question? Because these are done under executive order. This isn't legislation. This is executive order. It can be changed with the stroke of a pen, and it is. It's been constantly changing all over the map. And it could be illegal. I'm sure, and I think there are already court challenges to the legality of some of these tariff hikes. And what happens if the court system strikes it down, 18, 24 months from now, right when I'm ready to go open my new factory, my new vehicle manufacturing facility? So you can't answer those questions. You're not going to build in the United States. There's like zero probability you're going to do that. So no, I don't see this resulting in the reindustrialization of the U.S. Now, I will say, I do think if you go back to some of the legislation passed in the Biden administration, the CHIPS Act, the infrastructure legislation, the Inflation Reduction Act, that has proven to be quite effective in bringing manufacturing back. I mean, go look, and I'm making up the numbers a little bit, Peter, but someone can chat GPT it. But if you go back and look at investment in manufacturing facilities, manufacturing construction put in place prior to the CHIPS Act 2022, it was $75 billion per annum. give or take, for the decade prior to that. Last I looked, we were over $200 billion on an annualized basis. It works. It was working. Inflation Reduction Act, tax incentives to the private sector to go and, develop clean energy. That's working. That's manufacturing back into the United States. So, in my mind, that was, it wasn't free. It was costly. These were tax subsidies, but they were paid for in legislation, and businesses were counting on them, and hopefully, we'll continue to execute. But that's the way I thought, in my mind, a proven way to reindustrialize. Tariffs, just not going to work. And by the way, go back to President Trump's first term, that trade war, again, much smaller in scale than what we're talking about here. Go take a look at investment. It was falling off. Now, by 2019. Now, lots of things going on. We got a control for lots of stuff. We had the TCGA, and maybe that influenced things. But in the year leading up to the pandemic, investment was going in the wrong direction. Manufacturing jobs were falling. Manufacturing was in recession. It was not expanding or growing. So no, I don't think that tariffs are the way to go in terms of trying to reindustrialize, which I think is a laudable goal. One final point. This isn't about jobs. It's not about jobs. I mean, even if you see a lot of manufacturing coming to the United States, manufacturing is highly mechanized. It's robotic. In a good year, a fantastic year, the manufacturing base, which accounts for 8-9% of the job base, might give you tens of thousands of additional jobs, not going to give you hundreds of thousands of jobs or millions of jobs. So this isn't going to be transformative for the labor market or for these communities, hard-pressed communities in the middle of the country. That's not what this is about, even under the best of circumstances. And these aren't the best of circumstances. We're not going to get that investment.
Yeah. Switching subjects, something that ordinarily would loom very large, although it's been overshadowed by the tariffs, is the Tax Cuts and Jobs Act, which comes up for renewal. What do you think is likely to happen on that front?
Well, there'll be legislation under reconciliation. They'll come to terms on the individual tax cuts. They expire at the end of the year. They were implemented under TCGA back in 2017, 2018. So they'll be extended, as is, and then there will be sundry other smaller cuts. When I say smaller, in terms of their budgetary costs. So, and this is no order of importance, but accelerated depreciation, higher SALT cap, maybe something on tips and Social Security, because the president talked about that during the campaign. And, he does follow through on his campaign promises. I mean, so I think that might be part of it. And to help pay for this, and I don't think they're going to pay for it on a current law basis. They'll do it on a current policy basis. If they do it on a current policy basis, they'll get some spending cuts. The one that's most difficult, where the most money, is on Medicaid cuts. I'm skeptical they'll get that, but maybe they'll get work requirements, which provides a little bit of a pay for. And then they'll piece together a few other things. But at the end of the day, the net of all of it will be a small add to the budget deficit. Going forward, I don't think they'll rein in the budget deficit. They'll certainly not on a current law basis, and it will have little kind of economic consequence. The one thing that's going to be really important, though, is how they handle the Treasury debt limit, because as you know, that clock is ticking. The Treasury is going to run out of cash to pay all its bills. Question as to when: July, August, somewhere in there, or maybe September. And the question is, can they roll that into the reconciliation bill or not? If they're not able to do that, that could be pretty ugly as well. At some point here, how to get that done, given the kind of the reticence in the Republican Congress, which is thinly controlled through the legislative process. So at the end of the day, I think they accomplish those things. But from a macroeconomic perspective, what it means for growth, I think it's more on the margin. I don't think it's going to be that big a deal, but they're certainly not going to address our long-term fiscal situation. If anything, they'll add to that problem.
By the way, audience, please keep sending in those questions, getting some great ones here. I want to take a question that came in about oil and drilling. One of the things, the main ways that Trump administration talked about trying to balance the budget was by having a lot more revenue from oil, and that's not happening. The drill baby drill is something that the oil companies themselves don't like, because what that does is drives down oil prices. And since the shale producers are higher cost producers than, say, the Saudis, when the cost goes down, they tend to lose market share. So what's your thought about drill baby drill?
I've always been confused by that. You know, they were already drilling, you know, coming into the president's term. I mean, I believe, and someone could correct me if I'm wrong, but I believe daily production was around 13 million barrels a day, 13.5 million barrels a day, which was an all-time high. So we were already producing a ton of oil. And I don't know how you get that up when you're saying you want lower oil prices. I mean, as you point out, if you're an executive at a oil company and you say lower prices, you go, well, that doesn't compute. And oil prices are down. You know, I mentioned earlier, I think WTI is at 60, Brent 65. And I think the Dallas Fed just came out with its recent annual study of kind of production costs in the fracking field. And I think break even, someone can correct me if I'm wrong, I think we're pretty close to break even right now, you know, $60 a barrel, $65 a barrel. So that means if prices go any lower, you're going to lose production. You're not going to gain production. So I just don't see it. You know, I don't know where that's coming from. And I don't get it. Now, I do think there could be more LNG, you know, liquefied natural gas production. I think there's, you know, natural gas prices are still elevated in Europe in particular, and compared to the prices here, although prices here have gone up quite a bit because of demand, but there's still some arbitrage opportunity, and I think you could get more LNG and more LNG investment. But, you know, that's small potatoes in the grand scheme of things. That's not a macroeconomic, you know, that's not going to move anything on a macroeconomic, any macroeconomic dial. That's really a micro industry level thing. But I've always, you know, since I heard this drill baby drill, I just don't get it. I'm totally flummoxed by it, perplexed by it.
Yeah. Sticking on the budget for a minute, the Treasury Secretary, Scott Bessent, this is another question from the audience, stated that we have a cost problem at the federal level, not a revenue problem. Do you agree?
I think we have both. I think we have a revenue problem and a cost problem. You know, clearly on the cost side, if you look at expenditures share to GDP, it's elevated, and you know, largely because of Social Security, Medicare, and Medicaid. Really has nothing to do with, you know, non-defense discretionary spending, which is kind of where the DOGE cuts are kind of centered. That's not the issue. There's no money there. You're not really going to move the dial in the fiscal situation by cutting there. Not that, you know, you shouldn't take a close hard look to make sure there's no fraud and everyone's efficiency is you know, performing efficiently. No problem with that, but I don't think you're going to, and I think the evidence is increasingly clear that DOGE is not going to result in any meaningful, you know, benefit in terms of cuts. But and defense is defense, not much you can do about that. And interest payments are interest payments, you got to make those, and they're already, you know, over closing in on $1 trillion and rising pretty rapidly. So that leaves you Social Security, Medicare, Medicaid. That's where the issues are. But you know, those are tough problems to solve, and the president himself says he doesn't want to touch them. But that's, you know, where we need to go on the spending side. On the revenue side, yeah, I think revenues are also an issue. They're low. You know, they're not hot. They're not low relative to long-term kind of levels. But I think it's important to realize with the aging of the population, the demands on government for just providing the same services to previous generations raises the cost. So we need a higher level of revenue to meet that cost, to maintain our fiscal situation. So I think we do need more revenue. And of course, the revenue has to come from, you know, you got to go where the money is. It's got to be higher income, high net worth households. And by the way, they're doing quite well, thank you. I mean, if you look at, this is work that we did, the folks in the top 10% of the income distribution account for 50%, almost 50% of all the consumer spending. So that's where the money is, and that's where, you know, you have to go. IRS enforcement would have been nice. We're going in an opposite direction there, but more enforcement to make sure that people are paying their taxes appropriately. But here's the other thing I'd say. I think, and this is, if you know, a lot of this conversation so far has been pretty negative. The one positive thing that could happen, that could be a game changer on the positive side, is if we actually get real immigration reform. I mean, I think there's a lot of support for rational immigration. We want immigrants into the country that have the right skills, both at the high end and the low end. And if we can just come to terms on that and allow for more immigrants with the right skills into our country, there's clear evidence that that's going to juice economic growth in terms of both labor force and labor productivity. And that would go a long way to lifting long-term growth by, you know, even if you lifted real GDP growth by 10, 20, 30 basis points per annum, that solves a lot of the budget problems. It, you know, really takes the edge off and makes it a lot easier to address the other spending and revenue issues that we face. So I'm hopeful that we can get beyond, you know, the politics of this in the not too distant future and really come to terms on rational immigration reform. And if we can, then our budgetary problems won't feel nearly as daunting as they do right now. But I will say, if we don't do these things, you know, we got a world of hurt, because our interest payments are rising now very, very rapidly. Rates are rising, going back to my point about the loss of the safe haven status, or the diminishing of the safe haven status. And, you know, you just look at R versus G, you know, interest rates versus nominal growth, and we're getting to a place where this is going to become a real problem.
Yeah. Just on your point about immigration, I want to ask you where that optimism comes from, because on the face of it, Trump has said he wants to get all undocumented immigrants out of the country. People are talking about numbers like 11 million or more. He has not done very much on that, but maybe because he has his hands full on tariffs, one can imagine that he would turn his attention to that and send a lot of people home or to some third country like El Salvador. It just doesn't strike me as there's a strong political climate for any kind of compromise in Congress. So what is it that's making you think that there's a chance of compromise on immigration reform?
Well, I don't want to overstate the case. There's a chance. We can talk about probabilities, but no, and it's a matter of timing. So obviously, in the current environment, that's not going to happen. I mean, the president's going to pursue his immigration policy, and that, by the way, is another reason to be nervous about economic growth, because we've been reliant very heavily on immigrants going to work, and that's reversing, and that's going to become more of an issue in a lot of industries in parts of the country. So I don't see any headway there in the near future. I'm thinking down the road here, maybe in the president's second half of the president's second term, that he's, you know, maybe at that point we get a window. We're beyond the deportations, we're beyond the aggressive efforts to deport immigrants. We're now in a world where, you know, the politics have changed a little bit. We're less concerned. The southern border is secure. Have seen less of that kind of immigration that's upset a lot of voters and communities across the country. And hopefully the economy is okay at that point in time. And then we can get down to business. We came pretty close, Peter, back in the last summer. You may recall, Senate Republicans were on board with an immigration bill, reform bill that the Biden administration put forward, but obviously it got derailed in the election process that ensued. But so that does indicate there is an appetite out there for this, and we just need to get a political window. I'm not arguing that's this year, probably not next year. I'm hopeful. It's an upside scenario. It's not my baseline scenario.
Fine. By the way, folks, we're coming towards the end here. So if you have any questions, please get them in now. The lines are open, as they say, right? And here's one that came in. Mark, which economy around the world will turn out to be the strongest over the next 5 to 10 years?
Well, I'll have to say, broadly speaking, I'll give you a macro answer and a more micro answer. The macro answer is, if I had to pick a region of the world to invest in, it would be Europe. I think Europe is going to be the safe haven. And I think under pressure, the Europeans get it together. Otherwise they don't, but they'll get it together when they're under pressure. And I think they're under a lot of pressure, and they're going to get it together sufficiently. And
What does get it together mean?
Meaning they'll come up with some way to mutualize the debt, so they can issue debt to go out and invest and do tax subsidy like we did under Biden to get, AI and other technology investment. Invest in defense, which also generates economic growth and also addresses their issue with regard to Russia, the Russian threat that they perceive and I think is actual. So I think that's where I would go, and I think the rule of law, still prevails. It's very clear. Governance is better. It's messy, but it's a more transparent democratic process, and I think that's going to win the day. If I had to pick a country, though, I might pick Brazil because the Brazilians are going to get all the stuff. American farmers are going to they're getting crushed, right? Because they're not going to be able to sell to anybody. They're not going to be able to sell to China. All that's going to be diverted to Brazil. And so I think Brazil becomes a much more attractive place, because of that. So if I had to pick a country that, that I would invest in, that may actually be a beneficiary of the global trade war, it would be the Brazilian economy. How about that for specificity? Yeah.
That's great. That's great. How about the two most populous nations on earth, India and China? Without getting into too much detail, any quick thoughts on those two?
Well, China's got this, same kind of, has a host of issues, and now that they're decoupling with the U.S. and we're in this pitched battle, it's a lose-lose for the U.S. and it's a lose for China. Nobody wins here. We're all losers, and they're going to lose too. I don't see that, they're going to benefit from that. And they've got all kinds of other structural issues. Their autocratic government is not conducive to a well-functioning market economy. India, I'm more optimistic about. Yeah, I think they've got prospects. I do think a lot of potential, and they're starting to reap it, and I feel more confident that they'll have a brighter future. So if I had to pick one of the two, I'd be India as opposed to China.
India, yeah. Okay, well, I'm going to try to squeeze in maybe one or two last questions. Somebody asks, so this is a financial audience, so I need to get at least one financial question in here.
Far away.
How much risk do you see in the current credit cycle, especially, or e.g. in private credit markets?
Great question. And I'm about ready to publish a paper on private credit and its increased systemic role in the financial system. If you're really a nerd, you will really like this paper. We did a lot of really interesting statistical work. And the bottom line is the private credit market has now become much more systemic. And we're using the BDCs, the Business Development Corps, as proxies, just because we have data and information there. And found very strong evidence that the private credit has become much more systemic over time. I do want to point out one key thing here. When the economy, it's the obvious thing, but it's important to get it out on the table. When the economy is under stress, and if it's under stress for an extended period of time, and that's what feels like it's going to happen here, things go off the rails. Things that you can navigate through, if they're temporary, you can't navigate through. And I worry about the debt of non-financial corporations that have been levered up via private equity, and private credit. And you can see the stress already developing. Go take a look at distressed exchanges. So these aren't defaults. It's where a company's having trouble making its debt payment, goes to the private equity firm and says, hey, look, I'm not going to be able to make it. The private equity firm doesn't want to push the company to default because then they have to mark down their asset holdings. They work with the borrower through these distressed exchanges. One example would be take the interest that you're not paying, just roll that into the principal. So your principal amount starts to rise and you get a reprieve until. Now you'll do that when you feel like, you don't have this fundamental problem with the sales of the company. But if we get into a weak economy, which we are, or a recession, which we might, sales are going to weaken, and these firms, private equity, private credit firms, are going to say, I don't think this is going to work out, and they will start pushing these. Did I tell you distressed exchanges are a record high? They'll start putting those distressed exchanges into default, and that's when you see the job loss. That's when they don't default in distressed exchange. They default when they default, they'll start cutting jobs and investment. That's recession. And it could become, a systemic issue, just given what I just said earlier, a much broader problem for the financial system. And that's when this thing goes from being kind of a garden variety economic downturn to something that's much more serious than that. That's not my baseline, but that is certainly a downside scenario that people should consider.
So one channel is the job loss. That's what you mentioned. Is there
Yeah.
also a channel through the banking system?
Yes, through the broader financial system, because you got banks now providing credit to providing leverage to the private credit firms and private equity firms. So they're getting levered up and are more exposed. And then you've got a lot of insurance companies and pension funds that are, their balance sheet is stronger and they don't need to look, there's less chance of a run, but it doesn't mean that there won't be a lot of stress there, and that could create other effects around the financial system. So yeah, I think when I say systemic risk, I mean the problems in the private credit market bleed out into the banking system, the pension industry, and the insurance industry. I'll just, I don't know, I can't tell you explicitly what that will be, but it's something along the lines of what happened to the UK back in 2022, the Liz Truss event, where you saw the markets under stress, and it caused an exotic investment vehicle used by the UK pension funds to blow up,
Yeah.
and that created a financial crisis. That's the kind of thing that I think we need to be worried about.
Well, good. I'm really glad that question came in under the wire. And I do think we pretty much run out of time. I hear Barbara Van Allen is playing the music. Hi, Barbara.
Hello. Well, thank you both. That was just a terrific conversation. And also thank you to all those club members. I noticed that we're getting a nice long chain of questions.
Yeah.
Great job also, Mark, fielding those. So I just want to share real quickly, as we always do, a look forward. We have on April 22nd, Dan Loeb, the founder and CEO of Third Point, in a conversation with Andrew Ross Sorkin. In May, we have a series of events lined up, including John Bolton, who you will remember is the former U.S. ambassador to the UN. He'll have a lot to say, I'm sure, also about the situation right now underway with Iran. Ron Barron, the founder and CEO of Barron Capital, in a conversation with our very own Bob Steele, the chair of the club. Niall Ferguson, the Milbank Family Senior Fellow at the Hoover Institute, will be joining us. And I'm pretty sure yes, it is a reception, and it looks like that's going to be popular. And speaking of popular, that will be followed later in May 29th, by Glenn Hubbard and Larry Summers. That's another webinar, which is backed by popular demand from our members. So we encourage you to mark your calendars and plan to join us for these exceptional programs. And before we close, I always like to take a moment to thank members of the Centennial Society that joined us today, as their generous contributions provide the vital support that the club needs to provide our programming and fulfill our 501c3 mission. So thank you. And again, many thanks, Mark and Peter. Great conversation. And we look forward to having you all back, and of course, seeing all of our members and their guests in the future. So
Thanks. Thank you so much, Barbara. Thanks,
thank
Peter.
you.
Thank you. Bye.